What can you tell us about the Moat ETF?
Yeah, so the Moat ETF, it is intended to be an income-producing product. We've just seen such a huge amount of growth in the covered call space. I think there's over $40 billion in assets in Canadian covered call ETFs. And we felt like a lot of the put side was just being neglected and being ignored. So we decided to create a product that's going to be able to generate great income for investors. It's accessible in registered accounts, whereas our cash covered put selling is unavailable directly within those accounts. And going to provide some downside protection for investors. So it's really, in our view, the best of all worlds for downside protection and income production.
Great, thanks for that, Chris. Now let's back it up a little bit. We've been talking about puts. Maybe you can explain the difference between a covered call and a put writing program, because of course a lot of investors, as you say, are quite familiar with covered calls, but there's far less out there on the put side of things.
Yeah, so covered calls, we've just seen this massive growth, and it consists of owning a stock and then selling somebody the right to buy that stock from you at a higher price, but they pay you a fee or a premium in order to have that right. So this is something in the last 5 years that's grown immensely, and I think it's because it took a while for the market to really understand how covered calls work, the benefits of it, and any risks that are not associated with it. And the cash covered put side is different in that you don't actually own the stocks. So day one, you have cash that's sitting there and you're making commitments to buy stocks at lower prices, and for that you collect a premium. So somebody's going to pay us every day, every month that we're doing trades in order to make commitments to buy stocks at lower prices. If the stocks don't go down, we make that revenue, and if they do, then we're entering into those positions at much lower prices than they're currently trading.
Oh, that's very helpful. Thank you, Chris. Now, let's move this on a little bit. Within this income-oriented space in the ETF world, we have noticed that most things are rules-based or strategy-based funds where there's really not a lot of flexibility for the manager to react to what's going on in the marketplace. Your approach, on the other hand, is truly active. Can you speak on that?
Yeah, so we don't have a hard mandate geographically. We're a North American-based ETF, but we don't have any rules on how much Canada or how much US we need to have exposure to. So we're going to be constantly looking for value on both sides of the border. We also don't have a fixed set of stocks that we're going to be selling options on. So if we've got a basket of equities that we like and all of a sudden those valuations change over time, we will change and we will look to different pockets of the market. The other piece that we've seen with a lot more systematic ETFs on the call side is that sometimes it just doesn't make a lot of sense to sell an option just because you did it last month. So if you've got a mandate that says, well, we're going to sell options out 1 month, 5% out of the money, and just this really strict guideline, sometimes that doesn't make a lot of sense. So we've got that flexibility to use our discretion to find that value and sell options that are going to generate meaningful premium. And if it doesn't, then we look elsewhere, or we look at modifying the strategy.
Okay, so by being active, you're certainly not being trapped by the rules-based strategy. That's a great approach. Now, we understand the strategy. How about let's get into a stock itself? How do you pick a stock? How do you implement a put-right program?
So at the core, we are value investors. So the number one thing that we look for in anything that we're putting in a portfolio is a company that has quality, sustainable earnings, because we're not looking to speculate or buy high PE names that we just think need to grow into those valuations. So at the core, step one is looking for value-based equities. Then when you're looking at what to sell a put on, you've identified a stock that you like, you need to identify a price that you're willing to get long that stock. So we're not just selling puts on names that have big volatility or big premium. We're actually looking for names that we are comfortable getting long and holding for the long term. That's another big difference that we see amongst other products, is that we're not chasing that premium. So once we've identified a stock that we like and a level that we're comfortable getting long, then we take a look at the options market and say, okay, what type of premium can we collect for a reasonable period of time? Typically sort of 1 to 3 months is what we'll be looking at. And then if we can generate that premium, we make that commitment to buy the stock by selling that option at that level, and then we wait and see what the market gives us over the life of that option.
Perfect. Thank you, Chris. That's a great summary of how you approach the market and really bringing out a really unique, innovative mandate to the ETF landscape.